shocker in the finance world that rocked the markets for a time today. Silicon Valley Bank.
A panic spread on Wall Street in just 48 hours.
Silicon Valley Bank has collapsed. There was a massive bank run. This is the second largest banking failure in the USA. We have never seen a bank fail this hard since Washington Mutual Bank failed back in 2008 when the financial crisis hit. Many startups and VC funds depended on this bank. Roku, Roblox, and Vox Media all had money stashed in Silicon Valley Bank. Then, within 48 hours, the bank collapsed. Now no one has access to their money. US regulators had to temporarily halt trading for many small regional bank stocks because of the panic. Some, like First Republic Bank, saw their share prices fall by 60%. Silicon Valley Bank's problems even extended overseas as their UK branches shut down. Hundreds of British startups were unable to access their money. So what happened? How did a trusted Silicon Valley Bank with over $200 billion in assets collapse? To answer this question, we must go back to the pandemic years. Silicon Valley Bank thrived in the pandemic when more customers deposited money into their bank. Thrived was an understatement. The bank tripled their customer deposits. Now, usually, banks make money by giving out loans to people or businesses, and people will pay the bank interest payments through those loans. However, Silicon Valley Bank had too much money that it couldn't lend out fast enough. It's a bank's responsibility to make money from customer deposits. The problem was, not enough people wanted loans from the bank. Silicon Valley Bank gave out plenty of loans, but it wasn't enough. There were still piles of cash, billions of dollars of cash that Silicon Valley Bank had sitting around in their safes, doing nothing for Silicon Valley Bank's finances. So the greedy Silicon Valley Bank had their brilliant plan to buy securities like US Treasury bonds using that extra cash. All banks do this. Traditionally, bonds are safe. If you own a bond, it pays you interest payments over time. When Silicon Valley Bank chose to buy those bonds, bond interest rates were low at the time, around 1%, but it was fine as long as the investment was safe and the bank could collect those sweet bond payments. However, the bank didn't account for one thing. In a bid to get inflation under control, so prices of household goods didn't become too expensive, the Federal Reserve raised interest rates aggressively. Jerome Powell raised interest rates over time to 5%. That meant the bonds Silicon Valley Bank owned lost a lot of their value. Bond prices fluctuate like the stock market. If there's high demand, bond prices go up. If there's low demand, bond prices go down. Now that you could buy bonds at a 5% interest rate, who in the right mind would want those bonds with 1% interest rates that Silicon Valley Bank had? There was low demand for the bonds Silicon Valley Bank was holding onto, so the value of the bonds they were holding onto dropped. Basically, what happened was Silicon Valley Bank had bought too many bonds too quickly at the wrong time. Now, ordinarily, bonds are safe investments. Silicon Valley Bank just had to wait for bond prices to go back up in a few years. Problem was, all of a sudden, the economy picked up. Silicon Valley Bank saw a large spike in withdrawals. Startups and VC firms were running out of money since 2022 last year. They did massive layoffs to save money. Many people, startups, and VC funds were taking their money out of Silicon Valley Bank, so the bank had to give their customers their money back sooner than they thought. This forced the bank to sell their bonds at a price lower than what they initially paid for them, essentially forcing Silicon Valley Bank to lose billions of dollars. Silicon Valley Bank was still running out of cash after the sale, so they announced they had to raise money. However, the CEO of Silicon Valley Bank was a little too transparent and told everyone he lost $1.8 billion on a sale of $21 billion of securities unnecessarily. Silicon Valley Bank employees called the CEO stupid. One anonymous Silicon Valley Bank employee said, "You're in the business for 40 years and you can't raise $2 billion privately?" He should have raised the money privately so no one would panic withdraw all their money from Silicon Valley Bank, but it was too late. This sudden announcement to raise capital triggered a sell-off in Silicon Valley Bank shares. Turns out, transparency isn't the best policy when you're the CEO of a bank. Peter Thiel and other prominent VC fund owners were alarmed by the bank's sudden need to raise capital. Peter Thiel's VC fund advised companies in its portfolio to withdraw their money from Silicon Valley Bank.
So Bloomberg had reported that Founders Fund had pulled its own operational cash, I suppose, from Silicon Valley Bank.
We wanted to be in a good position with our cash, so we were doing the right thing for those investors. and then also doing as much as we could on the portfolio side of things to shore that up and communicate that we thought there was some risk that they should be looking into.
Withdraw your money now before it collapses. Famous Herbalife short seller Bill Ackman put out a 600-word Twitter rant warning US regulators to fix Silicon Valley Bank before it triggers an economic collapse. Mark Cuban complained the FDIC's insurance of $250,000 was way too low to deal with the situation. VC founders were yelling on Twitter about Silicon Valley Bank's impending collapse, and in doing so, Peter Thiel and the startup community triggered the very thing they were trying to avoid, a bank run. This might be one of the first social media-induced bank runs. Within a day, on March 9th, people tried to withdraw over $42 billion of their money out of the bank. Silicon Valley Bank tried to stop startup founders from pulling their money out by calling the police on them.
The NYPD responded to a 911 call from employees at this bank branch on Park Avenue South because upset clients showed up trying to pull their cash out.
They called the police on a group of tech founders, including an ex-Lyft executive. The NYPD were called, but they couldn't do anything as the tech founders were coming in every minute and they were not doing anything wrong. Obviously, calling the police didn't work. Silicon Valley Bank ran out of money and was forced to shut down. By then, Peter Thiel and co. had made out with all of their money. A big chunk of that $42 billion was affiliated with his VC fund, Founders Fund. Honestly, you can't really blame him when other VC firm founders would have done the same thing. It was either him who had money stuck in a collapsing bank or his competitors. US regulators, the FDIC, took over Silicon Valley Bank the very next day, on March 10th. When the FDIC, the ones that's responsible for ensuring the customer's money, takes over your bank, you know you screwed up. Initially, there was widespread panic. Many startups kept their money in Silicon Valley Bank. Many more were not FDIC insured. That meant each customer could only get up to $250,000 back through the insurance. According to S&P Global Intelligence, over 97% of Silicon Valley deposits were not FDIC insured, meaning most of them had over $250,000 in their Silicon Valley bank accounts. Most of the depositors in Silicon Valley Bank were involved with startups. That meant millions or billions of dollars deposited. There was a real possibility that they were not going to get their money back. Roku had 26% of their money there. That's $487 million gone. Rocket Lab kept $38 million in the bank. Lending Club also had $21 million in Silicon Valley Bank. Circle Crypto Exchange kept $3.3 billion in that bank. Unity Game Engine kept 5% of their money in Silicon Valley Bank as well. Roblox had $150 million in there. Making it worse was some companies were using Silicon Valley Bank to issue payments to employees or gig workers. A major payroll service provider called Rippling actually used Silicon Valley Bank to handle payments, meaning hundreds of companies that relied on Rippling to do payroll won't be able to pay their startup employees. Etsy also used Silicon Valley Bank to pay their customers, so they had to delay their deposits to sellers and other seller transactions in the Etsy marketplace. Silicon Valley Bank's CEO, Greg Becker, took a lot of blame for selling those $3.6 million worth of shares belonging to him a few weeks before the bank's collapse. It looked as if he knew about the collapse early on. It didn't help that Greg Becker was the ex-CFO for Lehman Brothers, which sparked the financial crisis of 2008. Greg had two banks collapse under his watch. You can't even make this up, so anger towards him is understandable. The collapse of Silicon Valley Bank had far-reaching effects. Silicon Valley lost a major lender for entrepreneurs. Small regional banks were losing the trust of their customers. Their shares dropped massively, prompting the temporary halt of their share trading. The government closed Signature Bank to stop more bank runs. This was the third bank to shut down within a week. US regulators didn't want US citizens to withdraw their money from banks en masse. They didn't want bank run contagions to spread. Everyone who had a bank account was scared. Their hard-earned money could be gone forever. A majority, around 97%, were not FDIC insured. It was either the government bailed them out or they had to wait for a larger bank to swoop in and buy up Silicon Valley Bank and then return customer deposits. Thankfully, US regulators confirmed the backstop. The bank won't be bailed out. Silicon Valley Bank investors and owners will certainly lose their money. However, Silicon Valley Bank customers will get their money back on Monday. Monday has come and gone, and there are still still long lines outside of Silicon Valley Bank branches where anxious customers are waiting patiently, stressfully to get their money back. Many of them are waiting to get into Silicon Valley Bank so they can transfer the money out to other large banks, maybe a JP Morgan, Bank of America or Wells Fargo, which are supposed to be safer than those mid-sized banks like Silicon Valley Bank. President Biden has reassured Americans that the US banking system is safe and customer deposits in the banks will be there when they need them.
And they'll have access to their money as of today. No losses will be borne by the taxpayer. Every American should feel confident that their deposits will be there if and when they need them. The management of these banks will be fired.
Meanwhile, there are Silicon Valley Bank employees selling office equipment from the bank on eBay. If you wanted a used tumbler for $51 or a box, just a box, with the logo of the second largest bank to collapse in US history, head on over to eBay and you can have it for $200. And if that's not your cup of tea, there's a newspaper with the collapse of Silicon Valley Bank as the headline for $8.99. Thank you for watching, like and subscribe.